All right, so one of the things I want to talk about was, obviously this market's a lot different than what we saw last week was a lot different than what we had seen the previous 2, 3 weeks, or even uh, 4 weeks ago, right? Because obviously when the market dips, things don't break out the way they're supposed to, but also chart patterns tend to fail more. I mean, there's just a lot more uncertainty, and it tends to really frustrate traders because you'll often enter positions and you'll think things will be going good, and then you'll get stopped out, and then you'll see the position go back up, or you'll see the position as soon as you buy it go down, and next thing you know, you sell it, and before right the minute you sell it, it starts going back up and ends up being a huge gainer. And so that's really frustrating, especially for newer traders or people with smaller accounts, because it's like you're pissing in the wind. You can't really get anywhere, and then before you know it, you're down $1,000 because you just blew all this cash on commissions and things like that, and so it's real frustrating. It's something that I have dealt with for uh, many of years. Hold on, many of years. It's just it's part of the game and it's part of the market. There's very little you can do in terms of fighting a choppy market, but there are strategies you can take to really minimize the effect on it and still be able to eke out some gains or good gains, as long as you're prepared for it and you're really diligent about it. Last week in itself was tough. Even I didn't make money, and I rarely go through. I'm over the years, for 8 years of my trading career, I had some really, really great months and really, really good weeks, and then I'd have some disaster weeks, and I was never that very systematic about things. And now, maybe the last 3 years and change, probably starting in 2007, 2008, was when I really started getting consistent, where I could, have a daily goal and then be able to hit it every day. And it didn't really matter the market conditions. I had my goal, and that was what I had to hit. And even this past week, I think I had like I had 2 down days in a row, and then Friday I was just flat. And so that has not happened this year, where I had 2 down days in a row, and I think that was Wednesday and Thursday, and then Friday I just traded minimal because I just didn't see. It was a casino, and I didn't see any edge in really playing anything either way, and so I just ended up flat. And I think I might have took like $60 on feed or something, and $30 on Porker, and that was it. I didn't have anything to do, and that's totally fine because that's a lot better than losing $1,000. And I've had emails from people saying, "Hey, I went a little bit crazy with my trades. I was jumping in and out of things, and I lost $1,000." And so we'll go over kind of how to combat that. So I guess in the meantime, so choppy markets. So what does that really even mean? Well, choppy market is a market that's, at least because we're mostly day traders, without an exact trend for a good chunk of the day, where you'll see the market go down and then you'll see it rally, then you'll see it go down. And obviously what we've seen over the past week was, well, the trend was actually down. But what happens is you get head fakes during the day that make you think that there might be a turn or a gain or a green day. And what we had often seen in last week was, there were times where the market was actually making a run and it was green, and then you just got faded. And that happens. We have been, and we talk about this, every week, is right. We have been in a range since 2011. When we get to that top of the range, we fade. And it's happened every time we get to the top, and it was no different this time. And a lot of people could say it was like the debt deal and that thing, and those do contribute to it. But in essence, only the price action pays, and the price action probably told us, when we were getting towards the top, that things that were going to get a little bit rough, because they always do. And then the political fiasco that's been going on in Washington exasperated the selling, and it kind of gave us a double whammy. And so we had a very strong downtrend for the market, and as you can see, we were down across the board. 4%, and then 4% for the Dow, so 3.5% for Nasdaq. So 4% in general, so almost a percent a day. So that's some pretty heavy selling. So my definition of a choppy market is, really when you start getting whipsawed both ways, where it becomes hard to short because every time you do, you get snaked out the other way, and it becomes hard to go long too. And so you just don't really know what to do. Are we about to bounce or not about to bounce? Are we about to crash or not about to crash? And, even though we had all this crazy news, the market really didn't crash. It was down 3.92% last week, which is, in the scheme of things, very small. I've seen the market fall, 3, 4, 5% in a day. And so over the course of 5 days, it was very steady, systematic type of thing. And that's what made it choppy, is that we didn't just have this big bull rush of selling. We had, ups and downs intraday that made it harder to trade. And so, some different things that we can do about it. Well, I guess the first thing you want to really do about it, I'm not good with this thing, but hold on. All right, so the first thing you got to really do, right, is figure out what kind of trader you are. See, what you have to recognize is what I do and what you may do is totally different, because I'm in front of the computer all day, and I'm in this, right? I'm living and breathing it, because I don't have anything else to do except, call my mom every few minutes to bring me over some food. That's that's the basic of it, besides trading. And you guys might have a job, or you might have kids, or running errands. There's different things and different goals that each person has. So the first thing you really got to do is figure out what type of trader you are, because that's what you have to match. If you're a swing trader, you probably shouldn't be following my scalp trades, right? If you're a swing trader, you want to follow my swing trades. And, if you're a scalper, then you might not want to follow my swing trades and try to turn them into scalps, and vice versa, right? So, what kind of trader are you? Are you a day trader, somebody that's in and out multiple times a day? Are you a swing trader, somebody that's, you could be holding for the day, or you could be holding for 1 or 2 days? Or, are you a part-time swing trader, that is entering positions and going for the bigger gains, less maintenance? You've got a job, you want to buy a stock, set a stop, and that's what you do. So, that's going to be really important, because fractals are a big part of, of trading. I don't put my swing trade setups on my day trade, and vice versa. Everything has a plan to it. And so what you really need to do is make sure you're not just jumping in, and especially this type of market. When the market goes up, if I'm calling day trades and you're a swing trader, you can probably just do it because the market's going up, you're probably going to make some money, right? But when the market's going down, that doesn't really fly. And so you really want to match up what you do with what I'm doing, and make sure you're not just jumping in and out of all sorts of random things. And so, match up your time frames with your trading style, with your strategy. Because, the one thing you'll notice about day traders and swing traders, often as a swing trader, like, I buy stocks on dips. That's essentially, when I'm doing a swing trade, and then I'm holding it for a while. So, a day trader, you might be selling your position because it's dipping, and that might be where a swing trader's adding his position. And as a swing trader, what we do is we trade between support and resistance. And so often, a swing trader will be selling his position into resistance, which is, 1 or 2 pennies more, and, that's where a day trader adds a position, because it becomes a breakout. And so you really want to keep track of that, because that's going to help you kind of stay out of trouble when the market's dipping, because you're going to have a more precise plan of entry. So really think about that. And if you don't know what type of trader you are, and you're just trying to be the jack of all trades and try to do a little bit of everything, that's fine. You can do a little bit of everything and be good at it, but not unless you have a very good expertise in trading with, years of success. I know maybe if 4 or 5 people that are good day traders and swing traders and long-term swing traders. I mean, it just doesn't happen very often. In trading, it's better to master one method before you add another. So it's better to be a master of one setup or one method than be above average in 3 or 4, because above average you'll just make enough money to squeak by. It's really only a very small amount of people really make money in trading, and so you have to be, you have to have mastery of a technique. And so the first step is figuring out what kind of trader you are. And if you don't know, get with me. I can probably help you out with that, because in my career I've vacillated between day trader, swing trader, all sorts of things, trying to figure out what matches me. And even up until 3 years ago, I was running a whole different company with 30, 40 employees, and I didn't have time to day trade. I didn't even know how to day trade 3 years ago. This is all, being a day trader is actually something that's very new. Even 3 years ago, I wasn't trading small caps. I was trading mostly swing trades and doing large caps. And so, I evolved into something different, but, I knew I have certain things that I build an expertise in, and then I added a whole new subset. And so get with me if you don't know what type of trader you are. I could probably help you walk through it, because a lot of it's going to depend on your lifestyle, how much time you can spend at the computer, your goals. There's not really much of a difference in income between day traders and swing traders. And actually, what I found is swing traders tend to make even a little bit more money, because, how many billionaire day traders have you ever seen? I mean, there's no such thing, right? Most day traders are just people that are making a couple $100,000 a year. All right, so there are many different options that can be used and adjusted to kind of get out of choppiness and really keep out of trouble. The first thing you can do is really reduce the risk to your portfolio per trade. As we've gone over the position sizing sheet, in the past, I use a 1% risk metrics, and so when things get really nasty, right, and really in the red, I moved that to 0.5%. One sec. And so what that does is off the bat is, what that will do off the bat, right, is it will cut your losses in half if you have them. And, it can cut your gains too, but the key is, you want to stay in the game. And so, if you're doing a 1% risk ratio, you're going to have certain metrics, but when you cut it to 0.5, that's really going to keep you out of trouble when the market's going down, because your risk is cut in half. And so right off the bat you've got extra trade. So what happens, like if you got a $50,000 account, right, you're going to risk $250 per trade. So if you get stopped out, whether it's a 9% or 4% stop, right, the max you're going to lose is $250. So that's going to help you sleep at night, because we rarely have more than 3-4 positions anyways. So, you can be sleeping and know, like, hey, I've got $750 of risk in my account, I'll live, right? Or I have $1,000, I'll live. And that'll keep you definitely out of trouble. And the thing that you can do, right, because obviously if your risk is less, your position size is less, and so the amount of money you can make is less too. What you can do, right, is add to your position on strength. If it starts moving in your favor and it doesn't fade. So if you happen to get one of the stocks, I don't even know, we'll see what some of the bigger gain stocks were for the week. OCNF, ULU. So if you're in one of these type of trades where you're consistently, on an uptick, right? Well, if you're at 0.5% and you're buying at $4 or something, you add on strength as it's breaking out. And so you're adding to your position and increasing your risk, but you're doing it in a stock that's moving in a positive manner. And so that'll help you lever up your gains while keeping your risk small. And then, what you're essentially doing though, as you have those gains, is, just stick a stop at your buy price so that you're basically, you get stopped out, you make zero, but you lose zero. Second thing you can do, and this is for day traders, right, is shorten those time frames. So those day trades, when the market's going from green to red, red to green, green to red, shorten the time frame. That 2-hour day trade, 2-hour breakout becomes a 15-minute or 20-minute day trade or scalp. Those short swings you were taking that where you might hold it overnight because it's a great setup that could run for a couple days, that becomes a day trade. And so, this way, instead of getting chopped out and whipsawed to the opposite side, you're capturing only the up part. And you guys saw it with some of the trades that we took. Some of them, like, SHZ, we had this stock, right? And we're making, it's at $3, right? It makes its run, and then, it fades. And so what you want to do, right, is be selling into those thrusts. And so instead of, you want to capture the up move and get rid of the risk of the down move. And so main thing is, keep selling on those spikes, or as it's moving up, right, intraday, what you're doing is you keep raising that stop and just locking in the profits. Now, these stocks are always a little bit wild, so there's always a good shot that you're going to get stopped out, but that's just part of the game. And if the market's tanking, any gain is better than no gain. And you can see we tried this trade again this day on the 28th, and it popped right to 336, and we sold off a few, and then I think we bought 322, and you can see the stock completely reversed. I mean, the stock was tapping a breakout spot, right? And so you're looking at, especially on a down day, this stock had strength, and then it completely faded. And, to go from 336 to close at 304, that's a 12% move, right, to the downside. And that's what happens in a choppy market, is that great setup all of a sudden turns into a short. And the one thing you don't want to do is, if it goes and tries to break out, right, and then it zooms past below your buy price, don't take the loss. Don't take the loss. It's one thing, sometimes I might do that, but, if you don't have that kind of money just rolling around, you don't need to be doing that. This was if it's a failed breakout, you don't want it to just fade all the way back down, because it's no longer a buy. It becomes a short almost, right? And so you have to be really quick with these things, because the stock can go from a breakout setup to a short in a choppy market in a matter of minutes. These things just get faded. And so that's why you really got to shorten your time frames, and there'll still be opportunities to make money. It just happens quicker, and so you've got to move quick. And if you have a job, right, and you can't monitor this all day, then you don't want to be taking this type of trade. You don't want to get into scalps or day trades, because it's going to be, by the time you get back from your meeting, what you would see is a stock that was about to break out, and then when you get back from your meeting 2 hours later, what you'll see is a stock that just dropped 12% from its high. And, that's not something that you want to be in. Oh, shoot. Hold on. Let me go back. Dun, 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 dun. Motherfuckers. Sorry. All right. So now if you're swing trading, what you want to do, and I find this has actually worked out really well for me in the past, is because the best swing trades are actually added when the market is weak, when the market's pulling back. It can give you great swing trading opportunities. But what's frustrating is with the chop, you can get stopped out really easily, because there's just so much volatility. Because what you're doing with swing trades, often, right, is you're trying to time not only bounces in a stock, but what you also have to do is try to time a bounce in the market. And so usually when a market's on support and about the reverse, those are great times to add, swing trades. And, obviously the market can always keep falling. But what you're trying to do is, right, time that bounce with the bounce in the stock and the bounce with the market. And it's still easy to get chopped out for the fact that there's just so much volatility, right? The market's running on news and rumors and things like that. And so, when you keep that 3 or 4% stop on a swing trade, there's just a good chance because, right, you're holding over swing trades, you hold overnight and you're getting gap downs and things like that. There's just a shot that you're going to get stopped out. And so one of the things that I found that actually works well for me when I find stocks, especially for swing trading, when the market starts dipping like this, right, I'm making crazy watch lists. I'm looking for stocks that I like, that I've wanted to buy, and I'm making lists, right? And I'm looking for entry points. What is the ideal entry point for this stock? And no matter what it is, if it's an IRA stock or whatever, right? You're making you're making a list, right? And you're looking for, like, FCX is a stock I often play in my IRA because it's a leader in the market. This is the largest copper/gold company in the world, and it makes billions of dollars a year in revenue and profits. And so, as the stock is dipping, right, I'm making mental notes and setting alerts of ideal places that I want to buy this stock. And so, obviously I like to buy stocks at support. So I would find that maybe this 50-day moving average is a great spot. So somewhere along the 52 range is my ideal spot to buy this thing. Now, what you want to do, or what I like to do, so I don't get chopped out of it, right, is I lengthen my time frame. And so instead of it being like a 1 or 2 day swing, I'm saying, you know what? Because I know that the daily action between 1 or 2 days, the market just goes up and down, and it might not end up anywhere or might end up lower. So what I do is I lengthen my time frame so that intraday chop or that 1-2 day chop, it doesn't affect me. And then what I do is I go a smaller position. It doesn't have to be half. It could be 3/4. And then I keep my stop loss longer. And they're in direct correlation, right? So if I go half a position, then I can keep my stop loss 2 times longer, and my dollar risk is the same, right? If you're risking $500 and you cut your position in half, but your stop loss is 2x, well, then it equals the same dollar risk. So, you're risking the same dollar, but you can stay in the stock and you won't get chopped out. And that'll really work well for you, because when you're trading more, when the market is dipping and you're trading more on a one week or 7 day or whatever time frame, then you get a chance to really catch the market bounce. And what you'll see is, one second, let me, Sean, can you hear it now? Well, restart your computer, see if that works. And what you'll see with the market is, right, what we've seen over the past is, right, the market, typically you've got 5 days. This one was a pretty big dip, but you typically get 1, 2, 3, 4. It's always less than 5 days of dip, and then you'll get some type of bounce, and a rather large one, And so 1, 2, 3, 4, 5 dip, and then boom, right? 1, 2, 3, 4, 5 dip, and then boom. And this one was a little bit longer, I must say. This one was tricky, but even in this one, right? You got some pretty significant snapbacks along the way. And so that's what you want to do. And so that's why I like kind of lengthening my time frame if I'm a swing trader to a little bit longer period, because most of the time when the market gets very oversold, and what I used to label oversold is, I just use very simple stochastics, and when the market starts getting to those oversold levels and it's dipped for 4, 5, 6 days in a row, you tend to see some very nice snapbacks. And it doesn't mean it's a reversal that lasts forever, but you see a pretty big snapback. And so I keep track of that, right? So 4, 5, 6 days, we're dropping, we're oversold, we're on support. These are good times to start, maybe nibbling on some swing trades. And then I'll just lengthen my time frame a little bit so that I can capture the move. And let me know if that, you need more detail on that. I can walk you through it a little bit more, but that's, the basic gist of it. In terms of, like what I was doing last week, right, is, what I kept saying in the spike chat room is just sell all the spikes. And, it's very rudimentary. It's not the best in terms of long-term strategy because your reward to risk ratios are all messed up, and there's really no rhyme or reason or planning to the trades when you're just kind of like, okay, sell spikes. But when the market is gapping down and you get consistent gap downs in the market, what that tells you is that there's an intense amount of sell pressure. And oftentimes, throughout history is, the market will tend to move in direction of its gap. Often there will be a gap fill and there'll be an attempt at a reversal, but, you tend to move in direction of those gaps. And so if we're gapping down and a stock spikes up, I mean, there's a good shot, and it's not 100%, of course. Nothing is, we deal in probabilities and percentages, but maybe there's a 75% chance that spike or the spike in the market or the spike in the stock gets faded. And so what you want to be doing is just selling into those thrusts. And what I like to do and how I determine where and when that thrust ends is, I look at the intraday chart, and, if it goes up too far, too fast, a little bit too parabolic, right, we take a little bit off the table. And I'm just using very simple methods. And I take it off the table. And I put a stop at the buy price. And now we're playing on casino money because we've locked in a small profit. And now we have our stop at the buy price, and we'll let the casino do it. We're playing on the house. And I'm okay with that. If I sell 1/3 of my position, I make $100 on it. It's like, oh, big deal, $100. That's nothing, right? But we make a lot of trades a day, and if you do it 3-4 times, right, you've got $400. And maybe out of those 3 or 4 trades, half of them they dip back and you get stopped out again. But there might be 1 or 2 that after you sell the initial spike, it might fade a little bit, but it doesn't stop you, and then it keeps continuing for the day. And then you have the opportunity to lock in a bigger gain. And so then on those shares, maybe you lock in $200, $300. And so before you know it, if you're doing it very systematically and just nip and tucking your way, you're up $700, $800, $900, and you really haven't done much. You know what I mean? Yeah, you haven't hit the home run, but I don't always try to do that. I know guys in their chat room, they have $10,000, $11,000 accounts, and they'll email me and say, oh, shoot, I mean, it's been the first hour trade, I'm down $600. And I say, how is that possible? We're nip and tucking our way. There should be not even a possibility that you lose $600 in a day. And, that's part of the money management and risk management, part of trading. Very few people can be great stock pickers. There's only a handful of them out there. Where you really make the money is by gaining skills as a trader. And trading skills is basically money management, risk management, and position management. And that's not a natural talent. That's not, something you're born with. That is something that you work on through repetition and doing things the right day. But anybody can learn it because it's just something that's rule-based. And then you do it with consistency. And once you do it with consistency and it's rule-based, now you can extend it for 1 year, 2 year, and before that's when you're a real trader and you're making money consistently and you can do it for a living. And that's the essence of it. See, I was always a fantastic stock picker, even when I was 18 years old. I had a crazy ability. I could take $2,000 turn into 50,000 in weeks and months, very quickly because I was a great stock picker. But those gains never held, and I could never do it just full time because, my trading skills sucked. I didn't have a rule-based system for risk management, position sizing, and money management. And the minute I learned those few things, and actually, all it took me was to talk to another trader, and we put it into action. That system. I mean, I was a full-time trader 3-4 months later, and so that's where you really make your money, because very few people are just going to be natural stock pickers. We have maybe 3 or 4 in our chat room, maybe 2 or 3. Mary Beth is she's got a knack for picking good stocks, and the Z-Man is good at picking stocks. But that's it. I mean, the rest of us have to learn how to be traders. All right, so in terms of the sell the spike mode, the one thing that I personally was doing last week is, and I was only doing it for partial of the time because I was in and out of my room a lot. Add 1/3 of, if it looks like a strong setup and the market is in an intraday bounce, add 1/3 of a position to your play, so that when you do get that spike, you can sell half of it. But now that you have a little bit extra in your position, you can actually get somewhat of a decent gain. And then what happens is, if that stock keeps going up, well, you have a decent sized position left because, you added a little bit, 33% more to your play. And so, you can do that with the Epic setup and, make sure then you have enough to start scaling out. And it tends to work because you'll be selling some on that first spike, maybe 3, 4, 5, 6%, and you give yourself an opportunity to hit the home run. But at least your position's big enough. When you sell half and you still take that 4%, if you get stopped out, big deal. You made 2% on the trade, good enough. The other thing is, and people actually work quite the opposite, is you got to do your homework. When the market is in dip mode, right, the homework you do should actually be more than even the homework when the market's going up. Most people think, when the market's going up, it's like, right, you're looking at charts and you see 1,000 setups and it's like, oh, I got so much work to do. Well, it's like, well, yeah, you see 1,000 setups, that's fine. That's fine, but everything is probably going to make some money. All you're doing is looking for a handful of them where they can fill out your day. When the market is dipping, you have to be a lot more careful, and it's not necessarily careful in finding great setups, but in terms of doing your homework so that before the market opens, everything you need to know about your stocks. That means you're studying or making your watch list at night. You studied your open positions or your portfolio at night before the market opens, and you determine where your exit points are for stop losses, for your targets. You're adjusting them for your open positions. All that work is already mechanically done before the market opens. If you're waiting, all you're thinking, it should be done prior to the market, so that when the market opens, the only thing you're worrying about is executing your plan or executing what you've already thought about. A lot of people, I often traded just off one laptop for a majority of my career, and heck, I had a 13-inch laptop. I was running bulls. I was running another company, and I was trading 3 accounts all off one laptop. And people would always and running the chat room where as you guys know, I mean, we're talking a mile a minute in there, and people that will ask me hundreds of questions in a day, and I can do that. And people always say, well, how do you do that if you've just got one computer and you got all these people there on Gmail asking you questions, and you're on Twitter celebrating yourself, you're doing all this. How do you do that? And I say, well, because during the day, and this is true, during the day when we're in the chat room and we're talking amongst ourselves and trading, I'm not worried about thinking on where I'm going to enter a trade, what I'm doing with some of my other positions I already have, what's my favorite stock, what do I like for the day, where would I buy it, where would I sell it, all that stuff, right? I've already thought about all of that before the market opened. The only thing I'm really doing is executing trades or executing the plan, answering some of your questions, and then I'll make some adjustments to maybe my stops. Sometimes at night I'm thinking, if I buy this at 3:30, I'll put the stop, at this place, where I might make an adjustment due to the stop depending on where the low of the day is, because the market opened a certain way and the stock went down or up, and the low of the day change, or its range change, and so I might be thinking about where to stick my stop, or where to update that. But that's it. One of the things that you guys will always have is this paralysis by analysis, and that comes true when the market is tanking more than anything. It's like when you decide to play stock and you're like a really great trader, you have the ability to calculate 30, 40 variables very instantly, because you've had repetition, you've had thousands upon thousands of hours of doing this, right? And so that cognitive load that's in your brain is reduced to nothing. It's automatic. And a newer trader, somebody that doesn't have a certain level of competence, they can't compute fast enough, as there's just so much data and so much noise, and you got Twitter, chat room, and all that. And then, their setups are going to crap. Their open positions are tanking. And so they're thinking, man, what do I do with my open positions? Oh, my God. These guys are calling these new trades. I need to raise some cash to get in the new trades. And before you know it, right, all of this hoopla gets you frustrated. It gets you frustrated to the point where you don't want to do it anymore, or it gets you frustrated to the point where you end up taking big losses because you're jumping in and out of stuff and trying to raise some cash and get this new stuff, and you have no clue what you're going to do with the stuff you already have, and you have this mental lock, a brain freeze. And that brain freeze, it could be 2 seconds or it could take you 10 minutes. And during that time is where your account starts going down. And then what happens is you notice your account go down. It's like, shoot, I've just lost $800 while I was thinking about this. And then it's like, wow, I should have already sold. Now maybe I'll wait for the stocks to come back because it's already tanked this much. And so then you're looking at it and you're hoping it goes back up, and then we're calling some other trades and you want to get into that. And then before you know it, your positions you thought were going to bounce keep going down, and now you get stubborn, and it's like, I'm just going to wait it out. And before you know it, what ends up happening is you just ended up with a long-term investment you're going to hold for 3 months because you froze and you didn't sell quick enough. And so now the stock's down 20%, and before you know it, you just tell yourself, well, I like this one long-term anyways, so I'll just add more to it later, average down, and then get out later. And then you do that 3 or 4 times, and now your whole portfolio is locked up in shitty stocks that are all at a loss. And then you know what happens next? The market makes an epic run, and you're on the sidelines waiting for those stocks to go back to break even. And then by the time you wait for the stocks to go back to break even, the run in the market's gone. You finally have some cash and you buy some new stocks, and then the market starts dipping again, and then you're back to where you started. And a lot of that's from that paralysis by analysis. And you can get rid of that load in your brain by writing down and thinking about what the heck you're going to do the next day. And I traded full time with a job while starting up bulls and running a company with 40 employees where I was traveling all over the place, and I was still trading full time and making very similar returns of what I do now. And the reason was I didn't have to sit there and think all day about, oh my God, the market's tanking, what do I do? I already knew what I was going to do. I'm like, man, I'm on the road. If this stock hits this, I'm going to buy it here. The market does this, then I'm going to sell it. But if the stock does this and the market does that, then I'm in. And I'm going to add more. And I already had it all planned out. And so that's what you got to really do. And so, the best thing really, especially if you're not finding stocks on your own, is, you go and you study the blog, right? And this will give you a kind of a decent watch list. And I won't have all of them, because there's, a million setups out there, and there'll probably be setups from the past blogs that are still in play. So, you look at my blog, find a few stocks that really pique your interest, that are your favorite plays, and you don't have to do it for every single one because, I might have 20 of them on there. But find 3 or 4 that really fit what you're doing, and then say, hey, I really like this setup, and what I'm going to do is, I've got a formation. I'm gonna log this up and see and really dig in on where I'm gonna buy it, why, and what I would do with it. And then what happens is during the day, whether I'm in it or not, you can ask me, because I often forget, right? Because I'm watching so many things, I might just miss something that's moving. It's just natural. Hey, Kunal, I had this CMED off your blog, and it's approaching that trigger mark. What do you think? I was thinking about buying at 670, and then sticking stop here. I'll say, oh shoot, man, that's pretty good. And blah blah blah. Now you've got yourself a trade that you've already thought about, and maybe you're just asking me for some confirmation, right, or some help to see if it's even worthwhile. But you already have your trade plan out. One second here. Let me just gotta turn this thing off. So do your homework. Do not be lazy, right? For every hour that I trade, I'm doing possibly hours of homework, right? I'm not just going in there and winging stuff. And you'll never see me. I wing stuff in trades in terms of, sometimes I just feel a stock and I'm winging in terms of I know it's going to go up. But, I don't wing my day. I always have a few things that are a possibility to be put in play. And, what you'll see is like a good friend of mine, like a Trader Market 247. And he does a watch list that maybe has 3-4 stocks every day, and that's it. And if those stocks are in play, oh yeah, Sean, you can ask as many questions you want. We'll get to them after, or email me. I don't know why your audio is off, but he has maybe 3 or 4 stocks a day that he likes, and that's it. He's got a complete plan for them, and then if they trigger, they trigger, and if they don't, they don't. And he goofs around all day, and he makes probably the same amount of money as any other trader I know. And he only makes a couple trades a day, and as a part-time trader, he's a full-time trader. It's his job, but he only trades part of the day. He likes to go hang out. He lives in Seattle, probably likes girls and drinking, and so he's out and about all day. So do the homework. Don't always depend on me. Use me as a tool. And I tell a lot of the guys, that Skype with me or, send me emails. And I tell them this, hey, find 3 or 4 picks that you like. Send me an email with your trade plan over them. trade plan, I'll tell you if it is legit or whether you might be a little bit loosey-goosey on them. So keep a trade journal. For every trade, this will help you really go. This is going to work for a couple of reasons. Number one, when you write something down on a potential trade, what it will do is keep you out of trouble. Because oftentimes, when you're looking at something, you think, man, this is great. I should get in this or do this tomorrow or, in an hour or right now. When you write it down, you realize sometimes that you're just stupid. It's like, boy, that's a stupid trade. And actually, I have we have a couple people in our chairman. They tell me all the time, like, why'd you buy that? It's like there's just this huge candle. You chase it. I'm like, you know what? Shoot. And then I look back on, some of the notes I took, and I'm like, oh, man, I didn't follow exactly what I was going to do, and right, I got caught up in it. And, having a trade journal will really keep you out of that mess. And what it also do is it's going to help you go back and see, number one, if you were following your plan, and if you were, you're going to be able to quickly analyze, what's happening to your trades. And what are the themes in the market that are making your trades fail, or what you're doing to make your trades fail, and that'll help you adjust quickly. So, how awesome would it be, right, if you just have a list of all the trades, that you took with the plan, and then actually what happened, how easy is it to figure out for you then what you're doing wrong, right? Because you can see it. It's like, oh, shoot, right? Or you might just be like, I didn't even follow my plan, and then it'll be real easy to figure that out because you'll look back and see your entry, exit, stop price, and be like, shoot, I didn't even follow what I was saying. I got caught up in the moment, which happens. I mean, that's a natural thing that happens to everybody. But that's going to really keep you out of trouble. So what do you do for every trade? Your reason for entry, right? What's your setup? Why do you like it? If you're not that good with names of setups, I mean, if you notice me, I wasn't actually trained technically. I haven't read that many charting books or anything, or don't do that indicator stuff that much. So I don't know the exact names of setups. I give my setups all their own names. Bottom, booty, bounce, annexation of Puerto Rico. I just give them my own names. And so I write my reason for the entry. It's an annexation of Puerto Rico. If it breaks over this, blah, 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 blah. So on and so forth. Next thing, entry price, right? A great stock is not a great stock, right? A great stock is only a great stock if you buy it at the right price. And, there's a million stocks that could go up 20%, but unless you nail the entry, then who cares? Stop level. What's your stop price? Or what would be your stop price? You might adjust it during the day if you're a day trader, but if you're a swing trader, intraday charts don't matter. So, what's your stop level? Think about it. Dun, 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 dun. So what's your stop level? Figure it out. What's the best way to do it, right? If you're swing trading, your stop is going to be probably different than maybe a day trader. While I'm swing trading, I usually like to look at daily charts of things and try to figure out, ideal stop level. If you can't do it from the daily, then, I'll pick up a 3-day, 5-minute chart, and that's about the most I'll zoom in. So 3-day, 5-minute chart or a daily chart, and you look for your stop level. Easy enough. Exit price or initial target. So, where do you think this potentially could go to? Make sure you write that bad boy down, because that's going to be key on whether, you're nailing your trades at the right price and whether they're acting the way you think they can act. And then, this is probably one of the more important ones, reward to risk ratio. So what does that mean? So reward to risk ratio is basically, what do you risk in terms of dollar, not dollar to your portfolio, but dollar on the stock, to your potential gain in terms of your target. So it's like, if you're looking at a stock and you say, a stock like HH, you might say, okay, well, if I buy a break of 110, my potential target could be 117. So I've got 7 cents reward, and my stop is would be here at 104. So that's my risk, or 103. So my risk is 3 cents, and my potential reward is right, 7 cents, so on and so forth. So you want to try to keep them 2 to 1 if you can. It doesn't have to be. I don't always keep them 2 to 1 if I have a high probability setup, and that's a whole different thing, right? There's two things that we measure as traders. One is risk, which is how much you're risking on the trade, and the other one is the probability of success of a trade. But if a trade is just a regular trade with regular probabilities, then if you keep something at 2 to 1 reward to risk ratio, what that's going to happen is, even if you're hitting 40% of your trades over the course of a year, you're still going to be in the positive. And so you don't have to be the best stock picker in the world then to make money, because your trade management skills are so elite that it makes up for it, and you're going to make money. And now if it's less than 2 to 1, maybe it's 1.5 to 1 or 1 to 1, then write down why you're taking this trade. Why is this such a high probability trade that I can take it without the best reward to risk ratio. I believe I wrote a blog on this. One second. That really kind of nails this down. A lot of you guys are new, but let me see if I can remember the exact details of this bad boy. Hold on 1 second. I forgot the exact numbers. Hold on 1 second. This will nail down reward to risk ratio in a hot second, why it's so important. Magic of reward to risk. Boom, boom, boom. All right. All right. So if you manage risk at a 2 to 1 ratio, not taking for account that some of your trades are going to be, huge home runs that end up being much higher than 2 to 1, because they could be 10 to 1 by the end of it. You only need to be correct 35% of the time to make money. That's awesome, because you know what? Even the biggest goofball in the world can nail 35% of his picks. Even I Drink Chai could do that, and we know he's a goofball. Now, so let's see how the numbers work out. So let's say you make 1,000 trades over the course of a year, right? 350 trades make $2,000 per trade. 650 trades lose $1,000, right? So now you've got a 2 to 1 reward to risk ratio. What ends up happening, right, is $700,000 in winners, $650,000 on the losers. So you netted $50,000. And look at how many more losers you have than winners. Almost 2 to 1, right? But not 2 to 1. A little bit less. And so that's where you eke out your profit. And so keeping your winners bigger than your losers, keeping your reward to risk ratio 2 to 1, that can be huge. Now, where you really make the real money, right, is, could you imagine if you move your reward to risk ratio when you're just a new trader, and say you're only, you're doing 2 to 1, but your winning percentage as you get better goes from 35% to, let's say, 50%, right? So now all of a sudden it's like you've got, I don't even know, this is 1,000 trades, right? So you've got 500 trades that make $2,000. You've got 500 trades that lose $1,000. How much more money do you make? Quite a significant more. So now all of a sudden you've got a nice living for yourself. And even as you're learning, you could still make some money. Like Rhino, I don't know if, I know he's a little bit more quiet, so nobody really follows him in the trades as much of late. But he has had probably over the last 3-4 months, somewhere often when he gets a little bit hot, he can go about a month where he's between 70 to 80% of his trades. And I seen in March he had actually 80% of his trades. And he's very stringent about using good reward to risk ratio. So, I mean, you can imagine how much money this guy made. He had 80% of his trades and he was running a 2-to-1 ratio. That's called boats and hose money. I mean, that's the type of money that pays for people's college educations and, houses for your parents and things like that. And it all starts, though. You got to start somewhere. And this 2-to-1 is something that you guys can do because that's on you, right? Is to pick a trade with 2-to-1. Oh, shoot. Boom, boom. All right, for new traders or guys with small accounts, this is my personal advice. During those times, just don't trade or be very selective. 1 or 2 trades max a day. New traders, it's actually really easy to build your account if you stay out of the nasty periods of the market. Because what happens with new traders is it's not finding winners. What really screws them over is when the market starts turning, they take too many losers, and those losers get too big, that it just blows up their account. And so the best thing to do is really load up when you see the opportunity, and when you don't have an edge, you get out. And, I know a lot of people try to, they always worry. It's like, I can't pattern day trade. It's like, well, almost every great trader I knew started trading before they could pattern day trade. Heck, when I was 18 years old, I couldn't pattern day trade, right? You have to build your accounts. And the way you do it is, right, you're being selective and picking times in the market where everything lines up in your favor, where you can throw a dart at a stock and it's probably going to break out. And you're not taking losses. And you're not getting eaten up by commissions from trying to just keep selling losers, then jump into another trade, and then sell it, and then jump into another trade and sell for a loss. Because if you have $5,000, $8,000, $9,000, you can't use stops because you're only allowed 3 day trades, 3 day trades a week, and so you can't use stops. So what happens, right? If it's like, what do you do if you load up 2-3 stocks thinking, something's going to happen, and all of a sudden you get in a choppy market, right? That's the whole point of this. In a choppy market, you get reversals. You get chopped out. This next thing you know, you only get 3 day trades a week. You just added 3 positions, and bam, you just stopped out of all of them, and you just lost a good chunk of your account. And because you can't pattern day trade. And the other thing is you can't use the strategy of selling into spikes, right? If you can't sell into spikes because everything's a hit and run, and you can't use a stop, then what the heck are you going to do? So just stay out, because one of the things that you see in the market, right, is that we talked about earlier, the market tends to only dip for 5-6 days at a time. Well, guess what? I mean, the month is long, right? Who cares about 5 days? You wait out the 5 days, 6 days, and you play the bounce, and that's when you make some cash, right? And you stay out of the nasty markets, because, I mean, it's just hard to make money when the market's dipping, and then it's even that much harder if you're at a disadvantage of not being able to sell things. Whether it's sell things for profit or sell things for a loss. And so, like I was when I trade my sister's account, or when it was small, I was only trading when the market was bouncing, or when I was seeing reversals, or when the market was just was breaking out of a consolidation or something like that, because it's not, right? It's not the gains, that really will help build your small account. It's staying out of the losses. when you can't sell, and you get this cascading effect where it's like, man, I'm at a loss, and I got to hold it tomorrow. The market gaps down, and then you don't want to sell because you don't have any day trades left, and you think the market might bounce, and so maybe you'll get some money back on the one stock you own, and then it doesn't bounce. So you hold it the next day. Now all of a sudden it's like, your 5% loss turned to 20% loss. And what are you going to do, right? Maybe you average down on it. It keeps going down. Now you just had this epic loss. And so you want to stay out of that. And that doesn't mean, right, that you can't be active in the chat room and stuff like that. And you can't be active on the blogs and hanging out with everybody. Because, Bulls is not just like, it's not about just trading alerts, right? We're trying to build people into full-time traders. And that means that you're in a constant state of learning. And so if you don't trade during those days, that's actually awesome, because what you can do is sit around with me all day, ask a million questions, bug the crap out of us, and learn some things. And spend that time learning, figuring out what works during this time, what doesn't, so on and so forth. And use that time so that the next time the market starts fading, maybe you've got a couple tricks up your sleeve, and you don't have to sit on the sideline. So while the market's dipping, spend your days watching, learning techniques that work in this type of market, and then spend the rest of the time making watch lists. And that's going to be huge. Just because the market's dipping and you shouldn't be trading it or aren't trading it, doesn't mean you sit on the sidelines, right? Make watch lists. Crazy watch lists. Watch lists with all sorts of stuff for all sorts of contingency. And so what happens is, look for stocks that are going to have the biggest bounces when the market turns, so that you have the chance to load up. Because usually the market tends to bounce for multiple days, right? And rarely do you see just the market get rarely do you see a market bounce for one day. You know what I mean? Especially off, bottoms, right? Of turning points, you tend to get at least 3-4 days minimum, right? And we've seen times where you get, a lot of days. And so you want to be making watch lists, because when that market does bounce, you're going to have some opportunity. That's when you have the opportunity to really start building up that account and go in, with some real money behind it, and find a stock that's going to run for 3-4 days, where you might have a chance to take out 20-30% on the trade. Bam, bam, bam. So that's it for the slides. Let me see if anybody's got some questions. Bum, 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 bum. All right, let's see. Click to open the question panel. I'm sorry, I'm a retard with this stuff. Talk about watch lists. You got one for tomorrow. Chai, I'm not even going to answer that question. All right. All right, so what type of stock setups work best in what market? Can you go over a few different scenarios we could run up, or similar different? What type of stock setups? All right, this is from Sean. Sean, that's maybe a 5-hour conversation right there. Maybe even longer. Different markets start to make our own watch list. So this is going to be tricky, especially FinViz. So oftentimes, and I don't know how to find these on FinViz. I actually recommend FinViz to people that have, if you have maybe less than 20,000, I just always use a free screener. There's no point of adding expenses. So a couple things you can do. If the market is falling and you're looking for stocks, there's a couple ways to do it. There's probably the two best, if you're looking for a turn, is run a screener for stocks that have dipped the most in the last whatever days, or stocks that are the most oversold. So performance, pick a performance of whatever. Yeah, I don't know how to use this thing. Hold on one sec. I haven't used this thing for a while. Earnings day, full sector, blah, 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 blah. Price. Well, basically what I do is I look for two things. Number one, I look for stocks that have dipped the most over the last whatever the period is of the dip. And then what I would end up doing is then go through all those charts and find anything with a reversal candle the day before or even a green candle, and that might set up like a pincher where you have the potential where it's going to pop the next day. And the other thing you want to do is, look at the top gainers or the new highs or whatever's near like a breakout or that's holding or hovering near a breakout. Those stocks, right when the market goes green, should technically break out. So there should be a way to do it here where you're looking for stocks that are maybe, say, 5% under 52-week highs. And that should give you enough enough leeway to find something that's going to be breaking out 5% or more below high, 0 to 5% below high, right? And then take that out, gap, candlestick. Well, you just, I'm not a big candle guy. I've always found them a little bit hokey pokey. If Shuzman's in here, don't tell him I said that. He might get mad at me for that. Market cap. So you got stocks that are near high. Maybe you might want to look at maybe something with some short interest, and possibly something with. I'd scan for current volume. Just keep it like, I don't know, keep it over 100K at least. Obviously more likely you want to do over 500K, but whatever it might be, right? So 200, 300K stocks between 0 and 5% of high. So now you've got 264 stocks that might break out. If the market turns. So, that's still a little bit too much. So then what you want to do, right, is probably screen it a little bit more towards what fits your trading style. So like I personally trade stocks, right, that are probably under $20 for the most part. So I add that. So now I got 56. So that's a lot more easier to look. So now I want to just start flipping through them. And I probably use candles because all this line stuff and indicators is mostly fake. Right? So I'm going to flip through these plain old charts and just start zooming through and seeing what I like. And seeing what may break out, what's on support. So like say something like this, CBB. This could be something that's interesting for me, right? Because it had a breakout right over this 340, had a very strong breakout, and now it's pulled back and it's consolidating. What you got to like about it is the fact that it's consolidating right at its breakout spot. Because what happens with breakouts, right? The old resistance becomes the new support. So notice how it's been, it's been hanging in there, right? We got some green candles in there. It's been hanging in there the last 2 days, hanging above its support marks. Even with the market tanking, right? Its support is strong. So this is stock. I say, man, you know what? This could be a good swinger, right? Because how hard is it to buy the stock? If you sense that the market's going to turn 346, put your stop at 338. You're risking 8 cents. You have a potential target of 360 or no, 365, 366, whatever the old high is. Bam, bam, bam. Now you got something. So just flip through this bad boy. And when you're flipping through them, you're not only looking for stocks that might be ready tomorrow, you're looking for stocks that might be ready in a few days from now. And so it takes a little bit of foresight, right? Hey, this is a nice pattern. Is it ready now? Maybe not. Could it be ready in a couple days? You bet, right? Flag it down, put it on your list, so on and so forth. So that's one way to do it. Now, me personally, right, because the market's been down so much, maybe I want to add a little bit of filter for shorts, right? Because we know a good short squeeze adds extra buyers into the play. All right, we got two plays with over 10% shorts. Actually, these are both decent charts too, right? And so these could be two plays potentially. I hope that helps, Sean. It's a tricky thing to pick the exact screener to work in what market, because there's 100 different scans that you can just run for anything, and it's a whole nother class. But we can do that sometime, that's for sure. All right. All right. So how do you catch those spikes? Hey, Frank, can you elaborate on that a little bit? I don't know exactly what you mean by that. All right. Dun, 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 dun. So harsh. Thanks, Chai. Can you share the link to the PPT? I don't know what the PPT is, my friend. How do I unmute? You should be able to upload everything. No plugin needed. Anybody else got any questions? It looks like most of this stuff is about sound and things like that. Anybody got stocks they want to look at? Send me an email or ask in that little question box. We'll be good to go. How do you have your computer screen laid out for maximum productivity? What do you have running and check during market hours? Oh, it's easy. I got my little lap and my computer here. Boom, 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 boom. So I keep open my quote tracker program. I keep open my Lake Street program. I keep open TweetDeck. And then I'll have open Gmail. And then I'll have open the chat room. And that's it. And yeah, I do it all. You can do it all off one computer. There's not much that you need to do. One screen. If you want maximum productivity, maybe one desktop and one laptop, or a desktop and an iPhone. Unless you're controlling over $100,000, I wouldn't suggest going with more than 2 screens. And I would not go with more than 3 screens unless you're controlling millions of dollars or making 50 trades to 100 trades a day. You just don't need it. Programs I run, Sean, I've got this telechart. It's $29.99. This is what I use to sort my watch lists, to make my watch list, to scan for things. It's probably my go-to. I've got the really old version that I haven't updated in years, so it doesn't have all the bells and whistles of the new one, but it works out well, and it helps me find stocks, because it's like, say XPO is going, right? Or, say GSS, or whatever, right? The GSS is going, I'm thinking, man, I got to find myself a stock like GSS. It's up 20%. So I can hit this, change watch list sub-industry components, and then it'll list me 49 gold, all the gold stocks that they have, right? And then I can sort it through whatever. I can sort it by momentum or price change, or whatever it may be, and I just flip through them with telechart. All you gotta do is hit a space bar, and you can flip through them. So like usually to get through 49 stocks might take me 20 seconds, 25 seconds, where I'm just flipping through what's on the bottom or what's on a breakout. Only two things I'm looking for, right? So boom, 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 boom. Okay, so okay, whoa, shoot, I just ran past bot, right? Right on support, breakout, pullback, bam, bam, bam. Looks good. I flag it, stick it on my watch list, and then boom, right? I've got some. So that's pretty much the tools I use. Quote tracker for my trading. Then my Lake Street account for like scalping, shorting, Telechart, Boom Factory, Tweeter. And I guess it's different for me than you guys. I don't read much like in terms of blogs and like news and things, or like to look for stocks, because I'm always under the assumption that everybody's reading my stuff looking for my stocks. And so that's my thinking, is everybody's probably reading my stuff, and so I just don't go looking for anybody else's. What reasons could you see for not entering anticipating day trades? PIX. John, you might have to elaborate on that. I don't know what you mean. Dun, dun, dun. All right. ALU swing trade. Let's take a look at this, my friend. ALU. So this is not bad. It's tricky depending on your time frame, though, right? You have at least a confirmed place where you can stick your stop. So I like that. Right, so it'd be like, I don't even know what that is. So wherever that area is, right, that's your confirmed place for a stop. So that, I believe that's 384. So you're at 405, so you're about 20 cents away. If it breaks past this high, right, wherever that is, you have the potential, so that's 420. You have the potential to really run to about 460-ish, the 200-day moving average. So, I would personally think, if you're swing trading this, it's not my type of swing trade, but I wouldn't say it's invalid or it's even risky, because you have a defined stop area and a potential reversal here, right? This could be a reversal day. And so I actually think it's kind of decent. I like it. Not my ideal type of trade, but you're only risking 20 cents, right? For the potential, to run up to 460, not bad. So you've got some leeway here. And so, you see a slight dip in the morning, or it opens up flat. You could probably take it and then just put a stop, and then, you just let it go. So, hey, not bad. Not bad, Rover. Roving eye, sorry. Dun, 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 dun. Let me see. All right, we got a whole host of these bad boys. EGHT, no problem, my man. EGHT. So this is not bad either, right? This is very similar to ALU in a lot of ways, without the big gap down. The only difference is it's in a tighter box than ALU, so it's up. Potential target might be lower, right? Because it's sandwiched between. It's got basically some type of confirmed support here, where you have an easy identifiable low, which is like maybe 378. But the thing is, right, you're at 379, so you got 12 cents on the downside. But we've already been tapping this 50-day moving average a couple times. So your upside buying here is minimal, right? Because it's like kind of stalls at around $4 and change. What probably the best way to do this, because your margin of error is a lot less than ALU, which would have probably been down here, is to buy it on the thrust through the 50-day moving average, and that would at least trigger like some type of day trade slash scalp, and then you put your stop, under the 50-day, and so at least you have some level of support, and that'd probably be the best way to play it, if you were to play it. This is probably not a stock that I'm looking at, but I could see the trade in it, because if it does bounce and get through this 50-day and clear this Thursday's high, you would be possible to see a run to maybe 455-ish. So you have a chance to eke out a good 10% gain on it, and so that it could be a powerful bounce for sure. All right, all right. What else we got? Questions. All right. Do you have compute? Can you take a look at DTL key? Give me a trade plan. Is how you might. Hold on one sec, Ellingford. All right. DTLK XPO. So DTLK, much more tricky, right? The real buy on this stock was, when we had in this candle for the breakout pullback. Now it's had a huge thrust pullback. It's for my type of trading, and I still take trades like this because I'm a moron, and I'll jump in and out of stuff. But this is a little bit more messy, right? There's no easy entry. Like where do you buy that's a low risk spot? Because the best entries, right, are you're coming out of some type of base, or you have some type of identifiable resistance. So identifiable level of resistance, and so it's hard to figure out from the daily what it is. Ideally, what I'd like to see on this is it base, maybe right around this 350 level, right, or a little bit below. Let it base for 3-4 days, and then what it'll end up doing is carve some type of box here. And maybe that box would be, between, right, these levels or something. And let it carve some type of box so that it can make itself an identifiable support and resistance, or area to buy. If that doesn't work and you don't have the patience for that, and you just want to take a good day trade or scalp out of the bad boy, then what you can do is just pull up a smaller time frame and figure out. You can maybe open a 10-day chart or something, and that looks a little bit more cleaner. And then just, let it rip. So it's like, okay, so what's this, 1050? So it breaks above 1050. You hit that thing with a $11 target, and, what you do is, right, so you've got yourself 11.50. So you got yourself, 55 cents, reward. You want to give yourself a decent stop, so maybe stick it under this base here um, that it was making on Friday. Right here. These are what, 30-minute candles, so that's a pretty decent support. So 1020 stop, that gives you about 30 cents, maybe, 25 cents, right? And you got like 1105, 1110 time frame, so 1150 buy, 1125 stop, 11 something target. That's about 2 to 1. Lot more. It looks a lot cleaner on this 10-day, 30-minute chart than it does on the daily. So sometimes you got to do that. You got to zoom in a little bit, and if you can't find it on the daily, and so this would be the time frame you'd use to really kind of figure out what the heck's going on this thing. Hope that answered your question. You can see here on the 20-day chart too, right? It's a lot more clean. Um, it's making itself a support, right? So now you've got yourself resistance, support, resistance. You've got yourself some levels here. So look at either a 20-day chart or a 10-day chart, and you are good to go. I personally still not sure because the daily does look a little bit like a girl with jangled teeth. Pretty face, messed up teeth. But it's a momentum stock, so they can go any period. You want to know about XPO? All right, so this is XPO, Expedite, Express Excel. Looks like a trucking company, right? So we know that this $4 level looks to be the breakout spot, right? Or soon to be breakout spot. So this one's a little bit tricky. Ideally, what I would have done on this trade is I would have bought whatever one of these last dips towards this 20-day moving average. So you can see here what it's been doing is bouncing off the 20, right? Multiple times, so the 20 is holding up. So if you hit that thing right around here in the 370 range, you put your stop at 360. You would have had yourself, a nice little, you would have been risking 10 cents with a potential target of 30 cents. And then, what you could have done is re-added it when it broke above 4. That would have been ideal for a swing trader. Now, if you're doing more scalping type stuff, then, it's a little bit different. Then you're really looking at it, if you're a scalper, that break of, that 4 level. You can see this is the 3-day chart, 5-minute candles. All right, so you can see here, tap, 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 tap. But there's, resistance above, so it's a little bit more tricky. Let's check a 10-day chart. There's no easy place to play this. You can hit that break of 4, and you probably have a potential target maybe 420. So that gives you 5% right there. This level of resistance. Where you'd stick your stop is going to be a lot more tricky. You might have to let it set up sometime intraday, or just, if it breaks 4 and then fails, you just let it go. Maybe give yourself a 1, 5, or 10-minute candle and stick your stop under there. It's not as easily identifiable. And a lot of those type of plays, right, when you're breaking, this is not necessarily a breakout, right? This is not a breakout. This is just 3 taps of a resistance level. So it's a break of resistance. It's a break of resistance, not but a breakout. So it's more of a scalp play. So, if it breaks out and fails, then just get out. Boom, 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 boom. All right, let's see who else we got here. Dun, dun, dun. Boom. All right, GFA. So I actually had GFA on um, the watch list. So GFA is a stock that I've played numerous times in the past. Um, Not for the last year or so, but when 2008, 2009, 2007, I was playing live. This is one of the two biggest home builders in Brazil. Brazil is just a market that I really like for a lot of different reasons. Brazil, number one, has more natural resources than really anybody in the world. Growing, developing population, and they've always had very stringent rules, much like India. Where if you basically for a long time, if you were going to buy a home, you had to just buy it in cash. You know, and that's why nobody ever built homes. They would just recycle old homes, and so now that these companies are kind of coming out of the darkness a little bit, these home builders are popping up. These people go to banks and get loans and stuff, and it's all very new. So GFA, I really like this. Number one, it had this awesome move, right? From 8.20 to $10. So that signals a reversal out of a downtrend. To me, it happened on increased volume, right? Some nice volume, sharp reversal, made an attempt at the 50-day, it failed, and as is the case when something pops 20% in a matter of a couple days, um, these things pull back, and so it pulled back, fell right to the 20-day, which is not only a 20-day support, but it also fell, to a certain level of price support. And so we have this like built-in layer of support, right? So a couple things you can do is number one, if it pulls back towards that 9 spot, you could add it for, a swing with a stop under basically Wednesday's low. And then, you'd have a target of basically the 50-day moving average, which is, give you a decent reward to risk ratio. And the other thing we can do is really keep an eye on it tomorrow. And, if it starts breaking through and takes out, Friday's high, which would also be the 50-day moving average too, is it closed below it. It tried to break it, but it didn't. That could set up us a day trade. And what I would be hoping for something like that is, if it takes this level out, I'd probably put my stop under the 50-day moving average. If it takes that level out, it could make a run for 10. And the thing is, if it makes a run for 10, and it can actually get past it, and we don't know if it can or not because 10 is resistance, but if it can get it past it, we have like a tremendous amount of airspace below to the next moving average, right? And really to the next level of resistance, which would be, kind of this zone right around here till at 11. And so, I think that there's something positive about this. And the other thing that I liked about this, you can see when it dipped, right? Even though these were some nasty down days, there wasn't a terrible amount of selling in terms of volume. And so, that's good too, right? Because we know that there wasn't enough selling to really break support. So that's it for GFA. I hope you guys answer. I hope I answered that question. Oh, Jonathan Brill, I recall these stocks being overly mentioned in the Boom Twit room, but notice you did not partake in either PEIX or LEDs. Um, yeah. I mean, I didn't participate because they were crappy setups. That's all. There was no, anything beyond that. They're not the type of setups that I trade, so they weren't on me. All right, seafood. Do you think AEZS is a buy here? Well, let's take a look. Bum, 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 bum. All right, so this stock is in no man's land for me for a couple of reasons. Actually, I've always liked the stock longer term. We have one of our guys that built our chat room. He's like obsessed with biotech stocks, and he used to always play this thing, and we always made good money on it. But now it's kind of changed. So where I would have bought this thing, right, was this tap on the 200-day moving average. That's the longer term support. That's the strongest moving average. It had a nice bounce. See, when it tapped it, it bounced from 85, $2. It had a very nice bounce. And then once again, it tapped it again on Friday, and then bounced 15 cents. So that there's no place to buy it now, right? Because how we play things. We're trying to play breakouts or pullbacks to support, and it's not at a breakout level, and now it's not really at a support level, so it doesn't give us an opportunity to do something that's low risk. Now, if it pulls back again to the 200-day moving average, you might be able to take a stab at it. It would be low risk in terms of you're not going to be risking much in terms of pennies on the trade. But the one thing I do warn you is that the more times it taps this 200-day moving average, the more likely it is to break below, because the market is all about supply and demand. And so every time it kind of taps this level, right, it's usurping all the demand at that spot, and sooner or later there just won't be any. And one of the things that you can always use is, right, the volume patterns. There was definitely more selling on this distribution day, and then these 2 days where it bounced was kind of light. And so they look like they're potentially what we'd call a relief bounce, or a dead cat bounce. Okay, so Bing, what kind of swing setups do you normally watch trade? So that's a great question. So I'm doing a few different things, and it depends on the market. One of the things, is I like to take, heavy momentum stocks, and heavy momentum stock, and buy those first couple dips, off like off the 20-day moving averages. That's a swing setup for me. As they dip, I buy, set a stop under, play for the bounce. And you'll see almost all the stocks off like my Momo list, right? They break out, then they'll pull back to the 20, and you'll get a nice dead cat bounce. And so what you do is you buy it close to 20, set a stop under, and it does that. And what you'll see is that almost all of them, at some point after the big breakout, will pull back to that 20 spot and then do a bounce. And it doesn't last, right? Because once you have such an epic breakout, the only thing you can do is fail that breakout. And so any that first bounce is going to be a dead cat bounce, but it tends to be a nice one. And so that's the type of swing trade setup that I look is, bounce off the 20 on the Momo. The other type of setup, that I like to do is what we call, breakout pullbacks, where, a stock will break out, then it'll pull back to that breakout spot, and then what you do is, you buy it, put a stop under, and then, you let it go. And so breakout pullback, bounces off the 20. I'm a very simple swing trader. Pullbacks to moving averages, just very simple stuff. Nothing too complicated that you won't be able to pick up in a short amount of time. Sorry, just clearing my throat. All right, can you take a look at a buy and hold these advantages at the same time? Anthony, that's a great question, actually. So it depends on the situation. So stock can hit support, and there's a lot of things that determine whether it's going to bounce. The number one part is, what type of support is it hitting, right? So when I'm looking at stocks that have been nailed and that are hitting support, I want a strong support, right? And so for me, like Holy, I don't see a support level here yet. I mean, it's got like a 1 day support, right? But ideally, I've seen stocks, some of the stocks that we've traded with those big bases, they could have, um, right? They could have like months of support building. You know what I mean? And so that can really hold up a stock. When you have just when you just have 1 or 2 days of support, it's really hit or miss. Right? Support, right? You're really building support. Um, when you just have 1 day of support, it's really hit or miss whether a stock um, is going to hold or not. You just don't know. One of the things that you can always do, one of the things that I often use to tell if a stock's pulled back to support and will it bounce is, look at the volume pattern. If it's really light selling on the pullback, there's a good shot it can bounce. It might have just been dumped by day traders type of thing. If there's heavy selling, then it gets more tricky. Now, Holy, there's definitely probably a play in Holy, but I'm not sure if it's a support play. There might be more of a rubber band snapback type of play where, maybe if it thrusts, I mean, what's that right now? 60697. It closed at its low. It's got kind of this reverse hammer thing going. If it opens again tomorrow as a gap down, and maybe if it tanks $1 or so, I might look at that as more of like a squeeze zone play on a parabolic dip. But that's like the hardest type of dip. That's the hardest type of dip by the time in the market. So, that's a whole nother 2-hour seminar. So this one's a little bit tricky. I would just say, if you do buy it, and if you do buy it, your risk is still a little bit low as long as there's no gap down, because you could just stick your stop here, and if it goes up, it goes up, and if it goes down, then who cares? You lost 20 cents or 10 cents, and if it does bounce, well, you've got a lot of airspace up here, So the probability of the success of this trade might not be high, but it can still be taken because the risk is low and the potential reward is high. So it's a low probability trade with high reward, low risk. And that's a trade you can still take. Does it mean, there's a big shot of hitting it? No. There's probably 35-40% chance of hitting it. But, as we were talking about before, you could hit 35% of your trades as long as your reward to risk ratios are in line and still make money. Frank, do I like gap plays off earnings report? I do. There's a specific way to play them, though. I never buy the gap off the earnings because you don't know if it's going to fade, right? And you don't know if you don't know how the market's going to react to it. What happens in pre-market is there might be there's a few jokers that look at it and say, oh shit, that's awesome, and then they buy it up and then they ramp it up pre-market and it fades. So what you want to be looking pre-market is the nature of the gap. Then what you want to be doing is looking at the daily chart, seeing where it's going to be gapping to. If it's gapping into resistance, you might not want to you just might want to let it chill, right? Because it could get faded. Where is it gapping to? Is it gapping into a spot that makes it a breakout chart, or is it just gapping into the middle of nowhere, right? So you want to look at the volume in the morning, see if there's some real buying interest pre-market off those earnings. That'll tell you if it's just a couple dudes like me screwing around buying 1,000 share lot, or if it's somebody important. And then the main thing is when I play that gap, I don't buy the gap up. What I do is I let the stock set up intraday. And so I let the stock base intraday go up and down, and then say it holds up all day, and then it takes out the high of that morning high, then I buy it on the break of that morning high. And that's when you get this epic trade that could run for quite some time. So Frank, if you look here, this I made a video on how to play PR releases slash 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 earnings report. PR's earnings are the same thing, and so that'll work out. Read that, study it. That's one of my best videos. Now, I've actually got a few videos to add to it, but it works really well. Derek, Born is something I like, but Born, it looks like you might want to check and see. For some reason, it's not moving much. It's got a really tight range, and the volume is like, went from like a couple million shares to like 30, 40,000. So there's not much selling going on. You might want to check when the earnings report is, though. Sometimes these China stocks, they really die out right before the earnings because everybody knows, like, Born is a legitimate fraud company. It's actually not even a real company. When these Muddy Waters guys, and everybody attacked them, a lot of it, they were right. They're like, yeah, you go there's no factory. Even Born says, well, our factory's in process. These are all fake companies. So a lot of times before the earnings reports, the volume really dies down, and people are waiting for the earnings to come out. So you might want to check that and see if the earnings are coming out. If they're not coming out, then it looks like a nice flag type of pattern that we could play. But what it does need is, a little bit of volume and, a little bit of love. And it's getting squeezed here. So, really any break, above this mark, I think could set this bad boy off. Maybe it needs like 710 or 720. All right, can you check PWIB at the bottom of support line, money flow, uptrend, breakout over 250, stop at support. Jerry, where do you find that what level do you like to support it? Maybe around 2? This stock, I don't know about it yet. When I play these bottom booty bounce, I like the big base, and then the 20-day kind of riding right on top of it, basing out, and then when it thrusts through, that's when I like to buy them. But overall, your risk is small. It was green on a pretty nasty day in the market. It's attempted to break and then fade, and it's attempted to break. So what you can see here through the past is, it has been trying to make a move to the upside, right? When the market was green, it went from 2 to 240 in, a matter of a couple of days, and then it faded along with the market. And then, on Thursday, it tried to make a move, no volume, but tried to make a move. And then it tried to make a move on Friday. So it seems to me, if I was just conjecturing opinions, that it's trying to make a bottom. Where you buy it is a little bit more tricky. I guess, if you buy it, you just buy as close to the bottom of this, support as you can, and just keep your stop under, and at least your risk is low. And, you let this bad boy roll. If you buy a 217, your stop is what? 205. That's 12 cents. That's a 6% stop. So, you'd have to at least, make sure that you're getting a decent rip out of it. But it still looks to me like the selling is over. So that's good. I actually kind of like it. Rock and roll. What do we got? Would you analyze CZZ? Yes, you know what? I had shorted this company in one of my accounts not so long ago, maybe a few months ago. This is a sugar company, I think. All right. This one's a little bit messy for some reason. So you're kind of in no man's land, right? 1233, you got your support. This 50-day didn't even hold a support last time, so I don't count it as support this time because it's already broken through. So your support is really, your near support is going to be the low of the day on Friday. So this makes it a little bit more tricky. It's like, where do you buy it? And I guess, if you're doing a day trade, you could buy this rip maybe over like 1240, but it's not a real breakout. You're just breaking really a 2 days or candles. So it's a little bit more tricky. I'm not sure exactly how we'd play it. It's a tweener. It's not a bearish chart for sure, but it's not a huge bullish chart for sure either. It's a tweener, right? The volume pattern, there's nothing special going on with the volume pattern. We're not really oversold. We're not at breakout. Well, we're close to support, so we're in between. And what you got to think about with stocks, it's like building you got to think of it like a lawyer, like you're building a case. And so things that you do when you're building a case. How's the volume pattern look? How's the overbought, oversold look? How is the price action look in terms of where it is between support and resistance? And so you're making checks, right? And then you're building your case for the stock. And so this one, we don't have all the evidence just yet. Uh, GRET, yes. Position sizing, the risk is about the same on every trade. I'll screw around with it though in case the market is tanking or the market is ripping a little bit. I'll make adjustments to it because I've done this long enough where I don't have to keep things static. I know when things are in my favor and when they're not. But I do tend to reduce it when the market is dipping. But then I'll keep it static. All right, B. Yeah, Sean, we get to the B. Hold on one second. All right, let the B buzz. All right, so B. I don't know if you own this or not. I'm not sure, but B is a little bit more tricky at the moment. So it ripped through below the 50-day, and then it tapped up to the 50-day. Now the question is, will it rip back up of it, or does it start drifting below? If it stays below, say, the 50-day for a period of a day or two, what it ends up doing is setting up a bear flag, right? Because a bear flag is basically a flag, like the flags we play up top. It's a flag on the bottom, and that would indicate lower prices. I don't like the volume pattern here. You can see really since its breakout, these up days are very small in volume compared to the down days. I mean, some of these down days are 30-40% more in selling. So that's a red flag. So I don't see an exact play off it. Maybe if the market goes crazy tomorrow and it rips back through the 50-day, you could probably buy it for a quick scalp. Right above the 50-day, stop under the 50-day. But that's not an easy play because it just had this huge tank and there's still a lot of selling in it. And so there'd have to be a tremendous amount of volume to really get this thing moving because there has been distribution. Man, is that all you guys got? It's only been 2 hours. Oh, Sean, I didn't see him. Shoot, what you want to know? Yes, please. Oh, yeah. The price alerts I set are when I do set price alert. Sometimes I forget. It's just I use this program called Quote Tracker. It's free for Ameritrade customers. It's like $12.99 if you don't have it. Real easy. New alert. Set price alert. I usually like to set it like maybe 2-3% below, 2% below the breakout, or like it's a $4 stock, like 10 cents below. Just make it something where you can get alerted to it, and you have enough time to check it out, open the chart, and then see if it's see if it's going to happen. And so I'll set it based on last price. Email, you can put an email alert. I hit OK, and we're good to go. If you need a free version of something, freestockcharts.com, they got decent price alerts too, and I think that they do email them to you also. So a lot of people in our chat room use this to do their live charting. I don't like it for live charting, but I like the look of it and stuff. You can do some different things with it. It's just too, I need to move quick, so I don't use it for live charting, but it's great for alerts and things like that. Set an alert, create reminder, set price alert, and that's it. It's pretty easy to use. It's definitely the one I recommend for people that need to be on a bit of a budget. Also, the other thing is, for me, Sean, I can do a lot of this mentally. So, my alerts I'm only setting alerts for a handful of stocks. I won't set 50 alerts, even though my watch list might be pretty long. It's too much. It's too many alerts. I've trained my brain at this point to have a watch list and, be able to look, just peek in and know what my triggers are. And also, what I do like about Quote Tracker is that, instead of really putting a watch list, sometimes I can just put a note, like breakout, break is at 5. And so, I could just put that there, and that makes it a lot easier than even a watch list, because I'll look and say, 417 is the last price, break of 5. So if it's at 480 or something, then I'm going to be able to catch it. In case my alert goes off a little bit easy, a little bit quicker. All right, but you're totally right. One of those things is keeping track of prices is part of that paralysis by analysis. Oftentimes, it's better as a newer trader to narrow your watch list to maybe just a few setups, or 10 setups, so on and so forth, and just wait. Roving Eyes, I don't know. I haven't read the news for today, so I don't know if there's a debt deal or not. If there is a big gap up, it becomes tricky. The nature of the gap up is going to be important, and where it gaps up to will be important. We have... Oh, motherfuckers, 1 second. No, that don't work good. Let me see. Sorry, my charts haven't updated on that program for some reason. Let me see. So if we gap up, where we gap up to is very important. As we can see here, this 1300 level seems to be, a decent level of resistance. And we've tailed through it a few times, so you got to give it some leeway. Like, we popped above it the other day too. The question is, where we gap up to. If we gap up, and say we gap up close to that 50 DMA, that could be pretty heavy resistance. So then that gap could be sent back. So the key is, right, gaps tend to fill at some point, and they might even fill that day, and they get faded. So as that gap is getting faded a little bit when it hits a level, when it gaps up in the resistance, what happens is that fade get bought. And if it does, then that's a good time to enter positions, not while it's fading, but if that fade gets bought. Or if that fade gets bought and then it takes out that morning gap up, then we've got ourselves possibly a multi-day runner, right? And so that's what I'll be watching. If we gap up, do we gap up into that 50-day moving average? If we do, we'll probably pull back right away and fill a little bit of that gap, and then do we take it out again? Do we do it with style? That's what you want to really look at. Do we take it out with style? A break is a break, but you got to do it with some gusto. And how you measure the gusto is, right, a lot of it's by feel, but, are you seeing stocks break out? Are you seeing big reversals? Are you seeing volume in the stocks that you're watching? Or is the volume really light and the spreads are wide? Maybe that tells us it's just kind of a short covering, dead cat bounce type of thing. Or you'll know if it's with style because everything will be running together like men. All right. AKS SGMO, no problem, Bart. Hey. I must say, you guys are cool dudes because we've been here for 2 hours and some change, and only 8 people left so far, which, is not bad. That means that 90% of you guys, or 80% of you guys, stayed the whole time. All right, so this is interesting. Huge, nasty fall. Potential reversal on Friday. What I don't know and why I'm not sure if it's a reversal is typically a reversal will have some good volume on it. A dead cat bounce or a relief bounce will have less volume than the dip days. And so you can see here we're at a fair amount of less volume compared to the down days. And so potentially could be a dead cat bounce that's happening here. The good part is, if you think that this might be the reversal, the risk is low because, you just stick a stop. You stick a stop, at Friday's low and you just let this thing ride a little bit, if this is something that you're interested in. Or, if you're thinking more of, just a quick trade, if it takes out maybe Thursday's high, that could set up a day trade and maybe give you 50 cents out of it. But I don't know. I can't say for sure or with any certainty if Friday was a reversal, just for the fact that see how oversold we were? The stochastics were on the zero, which kind of tells us that we were going to bounce anyways because it's just so oversold. So I'm not sure. SGMO. I used to love trading this stock. So this is very similar, right? We've had a reversal in some manner. Whether it's a reversal that sticks, we don't know yet. But the good thing is that we have an identifiable bottom that makes it so that, our risk is relatively muted, while we have a potential reward here of almost, up to $6, so about 60 cents or so. But, once again, the volume was a lot lighter than the down days. And so it can bounce. But what we do is we play probabilities, right? And so we're building our case. And so we look at things like the volume and things like that to help build our case. So, the market's going to gap up tomorrow. So there's a 99% chance the SGMO is going to go up tomorrow. The question is, is it a low-risk situation with high reward and a high probability trade? And we just don't know yet. and the other parts is probably might gap up to 550, 560. So then your reward to risk ratio is a lot less, right? Because you're very close to resistance, and so that negates pretty much your big advantage of the trade at this level, which is that it's near the low. Seafool, MACD, I've heard MACD works out pretty well. Um, from a couple people, especially the ones that trade like the lower priced small caps. You know, the MACD crosses can signal some potential running of momentum. But MACD is basically, if I remember correctly, MACD is basically just a crossing of moving averages, moving average crossover, something like that. And so it's just a combination of other indicators that you're probably already looking at. I personally tried it a few times, and it doesn't give me an edge on my style of trading. All right, what do we got next? Let's see here. Oh, Sean, how to read price action, e.g. Well, we're not really. I mean, reading price action is just we're buying. Um, we're, when you say price action, I mean what we're doing is very simple stuff, right? So it's like, on SCI, this breakout here, as it's breaking out, that means the price action is good, right? Because we don't have any resistance, and so that's how you're reading the price action. There's nothing complicated about it. We're buying basically, for the most part, breakouts, and so if a stock is breaking out, then that tells you the price action is positive, and if the stock is fading, well, then the price action is not so good. Um, that's pretty much all there is to it. I'm doing very simple stuff. Um, I wish there was like another clue into it, how to read it. I just trying to figure out how to put it into words without making it a 3-hour speech. Um, the market is all about supply and demand of shares, and so when you're not getting shares rained on your head, that typically will give you good price action. And so how you know that is, we're usually the shares get rained on your head when you're approaching resistance levels, and that kind of negates a lot of good price action. And so those are levels that you want to keep track of, and that'll keep you abreast of what the good price action is. And great price action is just when a stock is confirming itself, hence by going up, or actually breaking out and following through. And that's basically what confirms good price action. Seafool, yes, I'm sure that, there are times that some of the calls, could turn down, but it could be for, 1,000 different reasons. What you would have to test is, maybe 1,000 trades to really make, to see if that was the reason why it went down, right? Because at that time, if we were talking about WIBC, I mistimed the buy, not necessarily on the daily chart of the stock, but I mistimed the buy because I bought it at a point where the market was about to dip, and if I recall correctly, the market started fading pretty hard when I called out WIBC, and it was just not a good call by me. The market started dipping right away. There was just not a chance I was going to even move. And so, I just made a mistake basically. I should have just been more patient and just said, screw it, we're not going to trade today. And whew, losing my voice a little bit. But you know what I would say is, because since I'm not that good with that indicator or that familiar to say anything with expertise, you should keep a track of, my picks and then just overlay the MACD on it. And what you'll find is patterns. Maybe there's certain plays that I'm doing where it's working, and certain plays where it's not working. So what you'll be able to do is gather it and see when it works. You know what I mean? Because me personally, I'm not very studied on technical analysis in terms of indicators. And so I just don't know like how a lot of them interact with each other, because I just haven't studied them. But it doesn't mean they don't work, because well, shoot, the whole world is using them, so I'm guessing they work a little bit. We just got to figure out which ones work in what scenarios and what patterns. Like I use stochastics, but stochastics really only works maybe 30-40% of the time. It's got to be in a particular market. And the other thing I find with these indicators is they all contradict each other. So it's like, is there really any difference between stochastics and RSI? Probably not. They just work a little bit different. So who knows? I try not to. I'm not smart enough to overlay 5 indicators and figure out which one is the right one. And I've made it the last 10 years without really using any. So at least for my purposes, sometimes less is more, because I ain't so smart. TVSI, I think I like it. Yeah, I don't mind this actually. Oh shoot, I like it. How I play this is going to be a little bit more tricky. Probably how I would play it. No, I'd only do it if there was some volume behind it. Because, if it started taking out this range a little bit around here, start taking out this range, I would add it for a day trade and maybe see if you can tap out this old high. Nice volume pattern, right? There's a nice volume up thrust on these up days. Down days are pretty muted. Overall, it's a very positive pattern. One thing I'd probably be careful of is TVSI is definitely priced for bankruptcy at some point. They just got a huge debt load, so it's not something that I would marry. And this stock's, even this site, right? We're not in the business. At least I'm not in the business to marry my stocks. We're traders for the most part right now, and I definitely think, and I'm going to keep this on my watch list too. I definitely think that you got something here for a potential trade tomorrow. We'll watch it for sure. The other thing you got to really like about it, the stock, is that it made this run the last 5 days while the market was dipping, right? So that's pretty cool. So it's up 22% in 5 days. While the market's tanked the last 5 days, the Russell's down 5.3%. S&P was down 4%, right? So it's good relative strength. A lot of people would be nervous about chasing something that's been up 22% the last 5 days. I am not one of those people when I trade stocks, for the simple fact, what I like to do is always dig back into the past on how a stock has moved in the past before. And what we know is that stocks are turd, and they can drop 50% in a matter of 4 days, and they can also run up 125% in a matter of 1, 2, 3, 4 days, right? So 120% in 4 days. So this 22% that it's gone up in the last 4 days don't mean crap. It could have more room because we've seen it before, and that's important. Certain stocks, they go up 22% in 4 days. there's not a chance in hell that it's going to go up anymore because it's just not the part of their price pattern. And in this one, we've seen instances where it can move very fast for multiple days. Woo woo! Man, you guys kept me busy today. I like this. We could do this every week if you guys want. Oh, Stack. You know what? Stack is a crazy company, Anthony, and I'll tell you what. Because I've traded this back and forth for a long time, and they've repeatedly screwed themselves on earnings days. Um, you can see what happened with Stack a long time ago. Was $5. It made this huge run in a matter of this is like it's not even it's about a half a year, right? So it went from $5 to $40, and then what you started seeing was these big gap downs. All these gap downs happen because they screwed up their earnings calls. I'm talking like epic gap downs. I mean, and so you can see here, one gap down. They screwed up one earnings call. They had a gap down, right? Then they're here at the $15 range. They screwed up another earnings call and they gapped down. Um, and what we've seen in the past is after the gap down, it doesn't necessarily snap back up. It takes time. And so this one got snapped back up, but then it faded again, but it had a decent run in it. Um, but once again, look at this. Even in May, these goofballs screwed it up again. Gap down right off the earnings. And it took a while before it got bought back up, but then they gapped down again. And so the overall trend of this stock is, well, it's about to go back to $5 at some point if they keep gapping these things down. But what we do know is that after the gap down, it might be a day or two, but it could bounce after it bottoms a little bit. What I'd be very careful of is, see, the last time it had an earnings gap down, seeing these guys, they run their business basically like a Chinese company, right? It's all fraud, all rumors, because how else do you get so many gap downs that are like $3-4, right, on a large cap stock? That's unheard of. But what we can see is after the gap down a couple of times, right, it still had more downside. A gap down to $18, closed at 16, and went all the way to 14. It's a $4 range. So what we want to really see is how it bottoms out tomorrow. What's the price action like? So on and so forth. And you know what? If it takes out that kind of that 1064 mark, you might want. It could be worth a day trade at least because we've got this gap fill. And now is it going to fill the whole gap? Probably not, because these companies full of crooks. How else do you explain so many gap downs? They're missing their earnings nonstop. And there's a good shot when a company misses their earnings like this nonstop, there's probably something shady going on with it. They're stealing money, or there's some fake contracts. Think of it as like a Chinese stock, basically. All right, MGM. You know what, Sean? I have some MGM in my long-term swing port, and I like the company. And I think it looks actually really good for a swing trade too, because like we were talking about in the past, when a stock makes a huge run, like a huge run, right? That first dip to the 20-day moving average tends to get bought. And so I would anticipate this one getting bought also. I didn't like the selling on the dip here compared to the last few days, but it was digesting a very big run. And so, I would discount that a little bit, because you don't just make runs from 12 to 16 without a little bit of digestion. Held the 20-day. There's price support around here. I think, you found a pretty good one for a swinger. A lot of shorts in this. I would anticipate, see what we can see here, right, is this is a great reward to risk plays. You can see here this $16 is a pretty important level, so we could probably assume that we've got a good 90 cents left in this thing. And so I like it. Thank you. Good pick. Relatively safe. It's a safe stock. It's a large cap stock, but it moves fast. Hence these runs, right? It's a fast moving stock. I like it. I think you found a good one. WPO or SCB? Let's see. WPO or SCB. Let me take a look here. I'm not that familiar with them. WPO or SCP. Washington Post. I don't mind trading $400 stock. It's just like my question. The problem with say the Washington Post, right, is you kind of in a range, and kind of in a range on this side, on the top side too. So it's like what's your upside? Not much. If you were in the range, the problem is, think of stocks as like a box. When you're inside the box, you trade from the top of the box to the bottom of the box, top of the box, bottom of the box. And when you break the top of the box, the old top becomes the new bottom, and then you build a new box. And the same thing with when you break the bottom of the box, right? Now the bottom becomes the new top. And so what Washington WPO's got to do, right, is it's got to really prove itself, because now you've broken the box, you've got all this jumbled resistance above, but you can just see, like, this is not a clean chart, right? If I just showed you this chart like this, what could you say about it? You would just say, boy, that looks like a Rorschach test. You know what I mean? It's not clean. And sometimes clean is the best way to go. SCP. This is not an easy trade either, my friend. This is actually a legitimate setup. Right? You tailed down and then you reversed. Closed pretty decently. Normally that can be a sign of a reversal. The key is you gotta really watch this like 30 level here. Maybe it taps back up into this area, and that could be reversed, and then it could just fade back. A lot of selling in this. One of the things you might have to look for is that any bounce in this, it might get sold. It might get faded. So it's tricky, this setup. That's how I put it. Maybe if it breaks above 30, it could run to probably 31, I would think. There's a pretty good amount of resistance there. So break of 30, possibly could probably hit 31, for sure. Yes, you fool. Thinking of stocks in boxes is it just makes trading simpler, right? Everything's a stair step, everything's a box, and it'll clean things up for you in terms of how you're looking at stocks, because you'll be drawing those boxes on them. ZSTN. So this is a low volume stock. It's basically, this stock is moved around by message boards, mostly, iHub and stuff like that. So this is a kind of a breakout pullback play. I had this big breakout from 250 to 350, right? Had a nice 3-day pullback, and now it's just been kind of basing. Nice day on Friday on a down day. You legitimately could probably think, if you can cross over, 3, could trigger another trade, and maybe, go back towards this 340 mark. The key is just going to be, is China stocks in favor tomorrow? Is that the sector that's running? Is there any buyers behind the stock? Because this stock, tends to trade between 90,000 and sometimes it'll trade 10,000 shares in a day. You got to be real careful of that. If it's one of those days where it's only trading 10,000 shares a day, then it's going to be a little bit more tricky for you to time it, because one seller, he could, some guy like me that just buys like maybe 3,000 shares, he could just drop a market order on your head, and next thing you know, the 3,000 shares, a market order on your head, it drops the price 10, 15 cents. But I'll tell you this, Sean, that price pattern and that setup is awesome. The setup itself is awesome. I really like that type of setup. Breakout, pull back to support, starting to reverse. That's a go-to setup that can make you money over the course of your life. Anybody else? It's 11:40. All right, well, I guess nobody's got nothing. Let's see. Oh, Rage wanted to know about this. Hold on one second. Can't believe all you guys stayed. Not bad. Hey, this is not bad, Rage. This is a bottom bouncer, right? We're coming out of range. We're coming out of range. Nice look, probably pop over 13, could run back to 1360 / 20-day moving average. That stock definitely bottom out. The one thing I'd say is that I don't know if all these airlines bottomed on Friday because the oil was plummeting. Because if that's the case, because that's what often happens with airlines, if it was just reversing because oil was plummeting, well, oil could be gapping up tomorrow. So, does that put the sell pressure back on the stock? So keep an eye on that relationship, that inverse relationship, because it's not always inverse. Sometimes the rising tide lifts all boats and gas prices don't matter. It's just stocks are due for a bounce and they're about to go type of thing. If that's the case, then this looks pretty good. I actually like it. Yeah, this is the type of thing that I trade, so not bad. I would just keep an eye on the oil prices. Adam wants to know about leads. So leads is tricky, man, because it needs some news or something. It popped on Friday. This was I'm unsure on why it popped on Friday. There was something behind it. It could have been a message board thing, Twitter thing. So we'll see how it acts tomorrow. I think, probably where we got to look for this thing is maybe if it breaks over the 20-day moving average, that could trigger us a trade. So I'd keep an eye on it for tomorrow. 20-day moving average with some volume, and there's a lot of shorts in it, so it could definitely squeeze. And then you're asking about SCI. I actually really like SCI. Breakout, pullback. It's a breakout, pullback. It looks ready to me. I mean, I like this thing. You can see it right there, right? So we're basically putting ourselves in a little triangle thingy here. Test, 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 test. As soon as it breaks over, this could be a pretty good one. I'll stick that on my watch list for tomorrow. Appreciate it. Thank you, buddy. We'll even add leads just in case. All right. So we have had 2 hours and 40 minutes of pure pleasure. Anybody got anything else? Oh, LCC, another airline. Yeah, all the airlines got pretty much the same pattern. Arvin, EGHT, we just talked about this in depth a few minutes, an hour ago. It's a tricky one, right? Because we got support right here at 375. It's a confirmed support. We've tapped it 3 times, but we have resistance right here at 4. So you're in a little bit of a box here, right? You buy at 390. What's your upside? $4. What's your downside? This 375 mark. So right now there's more downside than upside, or it's about even. So the question is going to be, do we break over the 50? And if it does, it sets up more of a day trade type scenario where you buy the break and set the stop under. But I don't know if it's a good play for you because, it's more for, you got to be a deft trader, I guess, somebody that can move easily in and out and read things quickly. It's not a good trade it's not an easy trade for a beginner. No worries. It's going to be a little bit more tricky. So watch for that break over the 50-day, and then you can put a stop under. But you got to be around. It can't be one of those things where if it breaks back below the 50, I get an email 3 weeks later saying it's at 350 and it's now it's become an investment. Because if it fails at that 50, it's going to drop. Z is down after the IPO. Do you think it can go up? But almost all IPOs tank after the first day, so they take a lot of time. It can go back up, but it needs more time. Right? LinkedIn, big day IPO, boom, right? It takes a long time to shake out. Pandora, boom, back down, right? 26 to 13 the low the next day. Man, Yoku, when this IPO thing went, right? It went from $30 to $50, and then it was back at $30 the next day. So that the IPO plays, you want to bet against them, not go for them, at least in the beginning. And then the key is let them shake out for a few days, and then start to resume their uptrend. But it often takes a long time. I mean, sometimes I've seen some take for quite a long time. But all those IPOs trade. So for Z, just watch it for a while, because right now it's still making new lows, right? And so if it's making new lows, it's not bottoming. What we want to see is like a bottoming type process, and then you'll be good to go. Sean, yeah, I like Ren. We've been trying to time this thing for a while. My only worry about Ren is that it's almost too watched. Too many people are looking at it. What you'll find with these type of stocks, when everybody's looking at the same pattern and everybody's looking at the same stock, they tend to fail. The breakouts will tend to fail. You can see here though, it's bottomed. I mean, that's for sure. Are too many people watching it is going to be the key. Who's watching it? Is everybody and their uncle in on this thing? If that's the case, then the play's not going to work. You can see this 12 mark is the huge mark there, right? Tap, 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 tap. 12, when it hits 12, next stop, 14. That's going to be the big break. Right now we're looking at it more of a little break. Oh, I'm a Selena Gomez fan, not Hannah Montana. For sure. Wizards of Waverly. Dunkin' Donuts, not sure. It's getting priced as a coffee stock. And I guess they do sell coffee, so that kind of works. I don't know. It's in no man's land right now. What it is, because right, we don't have a setup where it's built a base for a bottom or built a level of resistance for a breakout. Um, it's just in between. And but what it is a great day trading vehicle because it's got a nice long range, but it's hard to pick a spot where you can swing trade it because we just haven't had enough days to develop support and resistance. And as swing traders, that's what we do. And we need identifiable support and resistance, and we just don't have anything because right now it's just kind of a mess. Because it's not a mess because the stock is a mess, it just hasn't had any time to make a support or resistance. All right, buddy boys, I think it's time to log out as I'm losing my voice. But you guys got 2 hours of me. Woo! And we'll do it again next week for sure. Just send me questions or topics of what you guys want on for next week, and we'll get this bad boy going. But I must say, this was fun. We got full participation out of everybody that came in. Only 8 people left from the beginning, so that's badass. That means there was 80% of you guys have nothing to do, or you just really like to learn. So have a good one. I will have this recorded and up on the website tomorrow sometime. Don't quote me on it. And I know Sean will probably ask me 1,000 times whether I can get it uploaded on the website. So I'm just going to tell him now that I'm going to try. All right, peoples. I shall see you all in the boom boom room. Get some rest. And we'll get to work tomorrow. Love you guys. Peace.